Hey everyone, this is Brian Bogner. We just want to take a few minutes and answer the question today. When will the Fed raise rates? Well, in our opinion, it doesn't matter. We have received a lot of questions, a lot of comments from folks about when is the Fed going to raise rates, what's going to happen, the market's going to crash, interest rates are going to go through the roof, oh my goodness, oh my goodness. Media has certainly been doing their part in talking about this. So we want to take the next few minutes and hopefully clear up a few things and explain to you about what exactly is going on when the Fed raises rates and why we think that whether it's this year, end of this year, beginning of next year, initially it really won't matter. Just bear with me one second as I get a few things going here on the presentation. There we go. Let's dive right into this. This is the Treasury yield curve, okay? So what this is this shows us for all the Treasury bonds that are out there, right? So this right here that says target, this is what the Fed, when you hear about the Fed raising rates, it's their target rate. It's what we call the very, very short end of the yield curve. And then as you go out 3 months, 6 months, 1 year, 3 year, 5 years, 10, 20, 30, okay, the interest that gets paid on those bonds moves higher, all right? Because if you buy a bond that's got a 30-year maturity, you're taking a lot more risk than if you're just, you've got your money in a money market that you can take out at any time. So you need to be compensated more for that. That's why a yield curve typically starts at the bottom left and moves to the top right. So when we talk about the Fed raising rates, we are really just talking about the very short end of the yield curve. Okay, so people think, oh, Fed's raising rates, that means mortgage rates are going to go higher. Not necessarily. A lot of times the Fed can raise rates and these long-term rates stay unchanged. So we'll dive into that here a little bit. All right, so what does the kind of most recent history of the federal funds rate look like? Well, this goes back 20 years. You can see here in the 90s that the Fed, actually for a good part of the 90s, that overnight rate was around 5.5%. So here we are down here around the 0.25. Over the 90s, we were up about 5%, and of course we know the economy did very well during that time, and there was a lot of good things happening there. Well, we got into the tech bubble, and the Fed aggressively started lowering rates. Got all the way down to about 0.75%, kept it there for a little while. Things started to improve. Then the Fed started raising rates again, got up to about 5%, and then we had the credit crisis back in 2008. Fed aggressively lowered rates and has been sitting pretty much at 0%. For almost the last 6 years. Okay, so if we take a longer term view, okay, this is the same thing going all the way back now to the 60s. This is somewhat unprecedented here, this action that we're seeing. As you can see, in the 60s and 70s we had high inflation, so the Fed had to raise rates very aggressively to fight off inflation. And they did that. And think about it, back in the early 80s, you could put your money in a money market and get 15, 16, 17% interest just sitting in a money market. That was pretty high. Then immediately, in the early 80s, things started to improve. Interest rates started dropping, and they've been on a downward trend ever since, with just this really low rock bottom here. So when we say that it doesn't really matter, because everyone's like, oh, is the Fed going to raise 25 basis points or 50 basis points or this or that? Well, think about it. If it goes up 25 basis points, it's barely even going to be a blip on the screen here. Not only is this long time frame, even this time frame here, maybe you go to 50 bips, maybe you go to 25 bips. The key is not when is the Fed going to raise rates. The key is this: how aggressively are they going to raise rates? Are they going to go on an aggressive rate hiking spree like we've seen here? Because that can have very strong implications. But raising the rate 25 or 50 basis points, or maybe another 25 or 50 basis points, if we're sitting here a year from now and the Fed funds rate's at 1%, has that really done anything significant? In our opinion, the answer is no. But if we see the Fed aggressively raise rates higher, I mean, in this case, you went from 0.75% up to almost 5% in maybe a couple years. That's pretty aggressive rate hiking. That is what we are watching and could have significant impacts. So let's talk about, we've been talking about the short end of the yield curve. Let's talk a little bit about the long end, because the Fed also has some influence over this part of the yield curve too, and they do this through quantitative easing, right? You've probably heard this in the news and heard this talked about. So what the Fed basically does is they, you probably heard they print money and they go out and they buy securities and they inject that money into the system or the banking system or the economy. And what they're doing is by buying, what they go out and they buy is they buy bonds. And what they're trying to do is they're trying to keep interest rates low, right? Because interest rates and bond prices are inversely correlated. So as they're bidding up these prices and buying these bonds, it's bringing longer term rates down. So sure enough, typically the Fed's balance sheet's been around, $750, $800 billion. The crisis happened, boom, they went on a buying binge. Their balance sheet is now sitting at about $4.3 trillion. And what do they own? Well, the blue here are Treasuries, and this fuchsia mauve color here is mortgages. So they own mortgage-backed securities, which are bonds, and they own Treasuries. So they have aggressively increased their balance sheet. And the Fed was the first to do this. Right now, all around the world, federal banks are doing this to try to keep interest rates low and try to inject liquidity and inject money into the system. The Fed has stopped. If you remember, late last year, they decided we're not going to buy anymore. We're going to hold off. And sure enough, all these numbers have flattened since then. And guess what? It worked, right? Because if you look here in 2009, a 10-year Treasury was about 4%. And as they went on that buying binge, it dropped down to 1, 1.4, 1.6. It really brought that 10-year yield down. We had a little spike here in 13. Bernanke said some things that kind of rattled the markets a little bit, but once we figured out, what he said wasn't really happening, rate came right back down. Now we've rallied a little bit here, but we're still only sitting at about 2.25% right now in the market. So the other thing that it did is this blue line is the Fed's balance sheet. So like I said, around $4.5 trillion. And the orange line is the S&P 500 over that same time frame. So by buying those bonds and lowering rates and creating all that liquidity, it has greatly also helped the stock market. Now, again, what we're watching very closely here is as the Fed has tapered, right, and they've stopped this buying, the market is also kind of moving sideways here as well. So we're, you can see historically when they've done it back in like 11 and 12, we had some corrections. 2010 had a correction, and then when they were aggressively buying, that's when the market was just kind of moving higher. So the interesting thing there. Now, so what the Fed has done is, right, they're not buying long-term bonds anymore. They're talking about raising short-term rates. Well, as a global investor, if every other country in the world is still in the process of lowering rates and still in the process of pushing rates lower, and you need to get higher interest rates, or you want to get higher interest rates, what are you doing? You're moving your money right now into US dollars and out of these other things because you think, hey, I can get higher interest rates. And so what have we seen since a year ago? We have seen the US dollar skyrocket compared to the other developed currencies. There's the euro, the British pound, Japanese yen, Swedish krona, Swiss franc have all gone down, and the US dollar has gone up. Matter of fact, the US dollar is pretty much the only currency in the world right now that is positive. Even if you look at the emerging markets, China's pegged the dollar, so that's why you're kind of seeing this as a flat line. But even in the emerging markets, all those currencies are down. And so the Fed raising rates does not just affect the United States, okay? It affects the entire world. Because even these emerging markets, they issue their debt in US dollars because most big investors are not going to buy their debt in their local currency. They want it in a safe, sound currency in US dollars. Well, if their currencies are dropping and the US dollar is going up, then these countries have to repay back that debt in US dollars. They're really getting hurt as well. So that's another reason why we don't think the Fed is going to go on a aggressive raising of the interest rates, because it will negatively affect the world economy, which again, filters its way back and affects our economy. The other thing, and I don't have a slide in here about this, is that inflation is really low right now. Okay, it's around, I think, 1.6, 1.7% or something like that. It's very low. And so there really hasn't been a time when you've had such low inflation that the Fed has to really start aggressively raising rates. If you remember back, and I'll flip back to the chart here, back in the early 80s, we saw the Fed funds rate really go high, but a lot of that had to do with they were fighting inflation. Well, inflation has been dropping over that time frame. Interest rates have been dropping. Inflation is still low right now, so we're just not convinced that the Fed is really going to raise rates. So just in summary, and to wrap this up, 25, 50 basis point raise will not be significant. How aggressive the raises is really what's more important. And you know, we're going to watch the dollar, we're going to watch inflation, and we're going to watch longer term interest rates for more meaningful analysis. So again, thanks so much for your time. If you have any questions, by all means, just let us know, and have a great day.